Welcome. Thank you all. Sorry we're getting started a little bit late. We'll try to respect your time and try to get through this as efficiently as possible for all of you. My name is Alex Perny. On with me is my colleague Corey Dayharsh. We will be presenting how to maximize your contributions today. So without that, I've been with Advanta since 2012. If you have any questions after this, please don't hesitate to give myself or Corey a call. I'll let Corey introduce himself, and then he'll get right started into the rest of the presentation for you, going into Roth and traditional IRAs, and then I'll pick it up on the back end for all of the employer style plans as well. So with that said, Corey, go ahead and take it away.
Yeah, thank you, Alex. Everyone, my name is Corey Dayharsh. I have been with Advanta since 2016. A majority of my time with the company has been spent as a client account manager. So in my specific capacity, I've funded thousands of investment transactions, and I have a wealth of experience on different strategies and different investment topics that can be self-directed. One thing that Alex mentioned, this topic today is part of a series that we're doing titled Tax Tips. So if you check out our YouTube page, there's going to be other tax tip videos that have been recently done, and we're also doing a few more moving forward in this tax season. So I just wanted to implore anyone interested to go ahead and check out the other content relative to the tax tip sessions that we've been doing recently. Now, I want to give you a brief disclaimer. Advanta, its employees do not specifically provide any investment advice, financial advice, or legal counsel. We do implore all investors to seek their own due diligence with their own attorneys, accountants, and other financial advisors before making any investments. All the information conveyed today is specifically for educational purposes that we will go over. So if you're not too familiar with self-directed IRAs, what a self-directed IRA is a specific retirement account that allows you the ability to invest into anything that you actually deem necessary with your investment strategy. Whereas larger custodians may specifically hold you to investing into products that they offer or items within their brokerage account or firm, a self-directed account truly allows you to invest into various assets, including real estate, mortgages and notes, private placements and syndications, precious metals, foreign currency, futures trading, and a lot of different things that you can actually invest into through a self-directed account. A lot of people choose to self-direct when they learn that it's a new strategy available. One of the main reasons is when clients learn of self-direction being an option, it's a new source of capital that they can utilize for investment strategies that they're already participating in. A lot of clients are also growing specifically fatigued with the stock market fluctuations. So you'll see this is a way to diversify your investment strategy and take on new avenues with your investment and financial goals, and as well as the tax benefits that come with investing through retirement account. Depending if you are in a Roth account or traditional account, your investments would be able to grow either tax deferred or tax free, given the status of the account in question. One of the main things that we do at Advanta that we try to use to set us apart from our competitors and other custodians in the space is we hold a high value on the education that we provide, like events like this. So we do events on a weekly and bi-weekly basis. You can check out our events calendar to see what's coming up next that is interesting to you. We also have a very robust video library on our YouTube channel. A lot of these sessions like this today are going to be posted onto the YouTube channel. So if you ever miss something you're interested in, you can always check out YouTube and find that content and review it at your own discretion. And if you are in the industry and interested, we do post a blog regularly that has updates and insight into the retirement account investing industry. If you are looking to get started with self-direction, the first thing to really do is open up an account. It only takes about 15 minutes to complete an application. You can schedule time with a colleague like Alex or I to go over and help you through your entire application. And once your account's opened, part of our model is you are paired with a specific client account manager. As I mentioned, I served in that role for about 5 years leading up to a few months ago. And that person's going to be your dedicated liaison for your investment strategy through the self-directed account. They'll be the person you go to with any questions, concerns, strategy, planning and other specific investments you'd like to make, they will make it a smooth and simple process for you. That is what we are here for. Funding your account can be done with a cash contribution, like we're talking about the limits for today, transferring funds from a current retirement account, and also specifically rolling over funds from previous employer plans. For example, my wife used to work for the school system. When she left the school system, she was left with a 401k plan or a 403b plan that she really couldn't do anything with. So getting those types of accounts rolled over to SelfDirected is a good way to start an account and get some of the cash that you've already got in a retirement fund working for you more efficiently. Once you've funded your account, you can start your investing. Again, you just reach out to your client account manager with the specific type of investment or even the specific deal you're looking to invest into, and they will help you make sure it's a smooth and simple process to fund that transaction. So this chart here goes over the specific contribution limits for the 2020 calendar year of various types of accounts. I'm going to save you all the time of reading through each of these going down the line, because we are going to get into them specifically on specific slides for each type of account. So this is here for the presentation in itself. It'll be on the recording, and if you are interested, we can pass along a version of the slide deck for you if you just email Alex or I. There are plenty of different types of self-directed plans. You can basically self-direct any of the existing retirement plans you may already have or are interested in opening. We've got a bunch of them displayed here. In specific case for today, I'm going to go over traditional and Roth contributions. And as Alex mentioned earlier, he's going to go over some of the other types of plans for small business owners, solo 401ks, and things of that nature. So basically the main point in showing you this slide is that for the most part, all of the types of retirement accounts you are interested in can be used for self-directed investment purposes. Now, as I just mentioned, I'm going to cover traditional and Roth IRAs. These are specifically individual retirement plans, individual retirement arrangements. For a traditional IRA, anyone that has earned income is eligible to contribute. There are limits for the deductibility of your traditional contribution based on your annual income. And then the benefits specifically of investing in a traditional account is you do get the tax deduction when you move that money into the retirement account. The growth is tax deferred until you take that money out of the IRA. And also former employer plans, like I mentioned, a former 401k or 403b, 457 TSP plan, they can all be rolled into a traditional IRA account with no tax consequence. It does allow you to generate and build your retirement savings, again, while deferring the taxes until later on in life when you're ready to distribute from that account. Traditional IRAs do have a required minimum distribution once you reach age 72, so you will have to keep that in mind as far as your strategization. As far as a Roth IRA, very similar to the traditional IRA account. Anyone that has earned income who does not exceed an income limit is eligible to contribute. And if you are exceeding that income limit, there are ways to get money into a Roth account. You can basically contribute into a traditional account and then convert that money to Roth after contributing. That strategy is often known as a backdoor Roth or a backdoor Roth conversion. It's just something that you can talk about with your CPA or tax preparer, given your needs and your situation if you're looking to get money into a Roth account. Once the money is in a Roth account, the earnings do grow tax-free, and there is no taxation on the withdrawals. Also, that required minimum distribution I just referenced is not actually applicable for Roth accounts, so there's no mandatory withdrawal limit at age 72. And also the strategy here, or one of the benefits, is that you would essentially see yourself in a lower tax situation this year and expect higher taxes in the future. So the benefit there of paying the taxes now so that your earnings and your funds in that retirement account grow completely tax-free is a major benefit to Roth investors. Now, as I showed on the chart earlier, the contribution limit for traditional and Roth account is $6,000 as of right now, and you do get a $1,000 catch-up limit if you are over age 50 and 1/2. That contribution limit is cumulative for all traditional or Roth accounts you have. So for example, if you have a traditional and a Roth account and you are under age 50 and 1/2 like I am, you could essentially contribute $3,000 to one, $3,000 to the other, or any split of that $6,000 total contribution limit as you see fitting for your goals, strategies, and your tax preparation needs. The contributions must be made up of earned income, so it has to be something that you're reporting as income on your standard tax return, and your contribution limit must be equal or greater to the earned income you have. So if I only made $4,000 this past year in earned income, then my contribution limit is limited to $4,000. I can't over contribute what I didn't physically earn in that year. Spouses can use joint income for contributions. We referenced earlier that there is a phase out for traditional contributions, deductibility, as well as a phase out for Roth contributions in itself. There are charts that the IRS has as far as where those phase outs are. And if you're interested in those, I can send those to you. Just go ahead and shoot me a message and I'll be happy to email that information specifically. Now, rules and regulations about traditional and Roth IRA contributions, they can basically be funded and combined into other accounts. So if you fund money into a traditional account, you can convert that to Roth to move that money and pay the taxes on it. You're able to open your new account all the way up until the tax filing deadline. In this case, for this year, that filing deadline has been extended to May 17th, which is basically an extension to May 15th, which falls on a weekend. So the following Monday, May 17th, is the limit to get a new retirement account opened, and you can get that funded from there on out using your 2020 tax return and contribution limit. And individuals over age 70 and 1/2 cannot contribute to a traditional account, but they can contribute to a Roth account because there is no withdrawal limit or specific required minimum distribution on Roth as opposed to traditional IRAs. Now, Alex, before we jump into your slides, I see there are a few questions. Have you had a chance to look over those and see if any of them apply specifically?
I have, and there's one kind of more specific to my portion of this, so I'll answer that before I get into it. And one is a little bit of a more just kind of opinion market based. If you want to answer the first one, or if you'd like me to go for it, just let me know.
Let me just read that question from D Mayo real quick, and then I'll be happy to assess and answer that.
And just real quick, just a small correction. The actual age for being able to contribute to a traditional IRA has actually been augmented to 72 now. There have been a few updates over the past years, namely with the passage of the Secure Act, which was the large previous administration bulk of tax reform. So that has actually bumped up to 72. So it gives older wage earners a little bit more options with regarding contributing to tax deferred accounts. So just keep that in mind.
Thank you, Alex. I think I used 72 in speaking, but I see that it's still here on the slide as 70 and 1/2. As far as the question from D Mayo, I'm going to go ahead and address that separately via an email. So Mr. or Mrs. Mayo, I will get back to you separately as to that question. Alex, you can feel free to proceed, and I will just keep an eye on the chat window.
All right, sounds good. So we have a question. So if I rolled over from an employer 401k to a self-directed IRA, more specifically a solo 401k, am I able to contribute to that account, and am I able to take advantage of the 2020 tax deduction? If the answer is yes, what would be the qualifying amount. So we'll get into the amounts here in a moment. But yes, if you have established a solo 401k, you are able to contribute for the 2020 year for tax deduction for the employer match portion. You've already kind of gone out of being able to do your employee deferral portion, which is the portion uh, of your earnings or your paycheck that you can contribute in, which is the 19.5 plus the additional $6,000 on top of that. So we'll get a little bit farther into that as well. And let's see, earned income. Can unemployment money be transferred to a retirement account? No, it is not considered It is not considered active or earned income. It is qualified under the same kind of thing as Social Security would be. So earned income being that if you have that money, but however, if you are showing earned income for a given year, but your cash balance maybe in an account is attributable to something like an unemployment benefit, yes, you've shown earned income for that given year, and you can use that even if maybe the check that you cashed was for unemployment per se. So with that said, let's go ahead and dig into the higher contribution plans. So the plans relating to things like 401ks, SEP IRAs, simple IRAs. So again, please feel free to pepper me with questions. I really enjoy doing these things. I've been doing this for a long time, and these are the kind of plans that I really enjoy digging into, just with the kind of complexities and the other things. See someone raise their hand, make sure you do type into the chat box for those questions. So SEP IRAs, simple IRAs, solo 401ks, who are they for? So anyone that's a sole proprietor, independent contractor, self-employed people, what does that exactly mean? Well, if you are someone that has a trader business, and you can be employed at a 9 to 5. So for example, myself as an employee of Advanta, if I flip houses on the side, or I have a digital online marketing platform, or heck, even if I play video games professionally, make money on the side, anything that is generating income that you have as a self-employed individual outside of a 9 to 5, or even if that is your full-time job being self-employed, these kind of plans can help you create great tax deductions, tax deferred, tax-free growth. So we'll get into that. So it doesn't necessarily have to fall into kind of a nicely defined box. You can really use almost anything. And what I'd encourage people, give us a call. If you mow lawns, I mean, really anything you can kind of use to qualify these plans and help create, significantly larger amounts of money that you can plug away into these types of plans. And again, they offer tax deferred and sometimes tax-free growth. You have significantly larger contribution limits, and sometimes you have the ability to have significantly lower administrative costs for some types of plans as well. The individual 401k, by far and away offering the largest potential contribution for a business without employees. Keep in mind that when I say without employees, that can mean a solo 401k can cover you, your spouse, or if the business is wholly owned and operated by shareholders, so you don't have any common law employees, meaning that you have an employee that works 500 or more hours for you over 3 out of the past 5 years, or if you have someone that works over 1,000 hours per year for you and is over the age of 21, is automatically opted into being able to participate in those plans. So just keep that in mind, that some of these plans are going to be a little bit more dictated on your choice with regards to employees than others. Okay. So what type of employees are excluded from these plans? Now, this may seem kind of harsh, but it's important to understand because it's going to directly affect what type of plan you might choose if you're a small business owner or if you're a self-employed individual. So you can exclude people that are under the age of 21, non-resident aliens, and unionized employees that engage in collective bargaining agreements that will typically have uh, larger, what's the word I'm looking for? Pension-based plans. The reason for that being is that when you have those types of employees, and this is especially important for people like general contractors, if you have a unionized labor force that you sub out to, you might be able to use a solo 401k because you have excludable employees that do work for you. Again, the 500 hours over 3 consecutive years or 1,000 hours in any given year, you must include them in a 401k, and that will increase your cost to administer that type of plan. Things that come into play are what are called discrimination and plan top testing, meaning that you have to have external audit showing that you are fairly offering the plan to all eligible employees. Now, you don't have to do that with a solo 401k because the Department of Labor deems that if it's just the nuclear single individual or their spouse operating the business, there's really no need for that kind of additional overhead. So that's why those types of plans are significantly cheaper to operate than larger 401k plans. SEP IRAs, you can exclude anyone that has worked. You cannot exclude anyone that has worked at least 3 out of the last 5 years. And simple IRAs, these kind of plans are really good for people. Maybe if you operate a seasonal business, we're here in Florida, people that, maybe rent kayaks and paddle boards, or you operate something that is extremely seasonal. These types of plans are good because those individuals that may not necessarily want to participate in a plan can be excluded because anyone making less than $5,000 in compensation can be excluded unless they've worked that for more than 2 years. So just keep in mind that the plan choice might inherently be predicated on what type of employees you have if you do have employees. So SEP IRAs, these are going to
Hey,
be
Alex.
really popular. Yeah.
There are two 401k questions, if you'd like to address them real quick before we move on to SEP and Simples.
Oh, sure. Okay.
So I'll read you both of them. The first one's from Christopher. Is income from rental property considered earned income? Can this be contributed to a solo 401k?
So that's all going to really depend on how you're showing that revenue. So strictly speaking, rental income and royalties are passive income. However, if you're looking to establish a solo 401k, again, and just to go back to our disclaimer, we cannot give tax or legal advice. But if, let's say, you just own 1 or 2 rentals and you want to use a solo 401k to help defer some of that income, you're going to need to have to show for the 401k contribution a portion of that is being paid out as revenue, so salary to you, because part of it's a salary deferral. The other portion is a contribution based on the net operating income of the business. So you might need to restructure some things, maybe form an LLC. In certain rare cases, maybe incorporating as a C Corp might be advantageous to being able to maximize your contributions. But if you own rental property and you are making money from that, then the answer is typically yes, you can do it, but there might be some tweaks that you need to make to exactly how you're showing that revenue coming in to be able to maximize those contributions.
Thanks, Alex. And the second question comes from Sarah. So can you use a 401k plan for multiple people as long as they are shareholders/owners as well?
Yes, you can use a solo 401k, and the definitions are kind of important because you can use a 401k that has 100 employees to invest in real estate if you have the right type of plan. But what we're talking about here being a solo 401k, I think is specific to what you're asking. Yes, so if you have, let's say, 5 people that are not related that own a business, and let's say it's a property management company, and those are the only people, they all are shareholders or equitable owners of that business, then yes, they can use a solo 401k that has that much lower threshold of administrative cost for them. I actually have people that have 6 quote employees of that business, but they're all shareholders of the business. So they can use the solo 401k, drop their overhead costs, and make it a much better fit for them. So that's one of the really cool parts. And thanks for asking, Sarah, is that's exactly spot on, is that if they're all equitable owners of the business, and doesn't matter the percentage, it can be a 1% owner, you can use the solo 401k. But it's when you start bringing in those rank and file 9 to 5, what are classified as common employees, then you have to have a different type of plan. But great questions. Thanks for asking. So getting into the SEP IRA, this is basically the newer version of the simple IRA. So for a SEP IRA, you're basing your contribution limit solely on what you're being paid as revenue to yourself. So those individuals which have high earned income, so people like realtors, if you're flipping houses, people that just maybe own a couple different businesses that are self-employed and have a few different things that they're doing might really benefit from this, because you can contribute up to 25% of your pay not to exceed $57,000 per year for 2020 and 2021. So you can get a lot of money into these plans. Now, keep in mind, a SEP is always going to be a deductible contribution. So if you make a lot of money and you're really looking to contribute as much in a deductible fashion, that's going to be a benefit to you. Now, keep in mind that this is going to be a corporate deduction. So depending on how you are filing your taxes, if everything files as a pass-through, you get to take full advantage of that deduction. So think people like that are sole proprietors, people that are filing as a subchapter S corp. If that's an LLC filing as a sub S, it doesn't matter. If you're filing and you're generating that revenue as a pass through, then the deduction passes on as well. But if you're in something like, let's say, a C corp, then that deduction would be taken on the corporate level because the corporation or the entity is making that contribution to the plan on behalf of the employee. Again, boiling this down, if you're self-employed, that means that that's going to essentially pass on directly to you, and you're contributing a portion of your paycheck, to that plan. So that's where the really big benefit's going to be for this. But keep in mind, there is no Roth, and you have to earn a lot of money in order to be able to contribute the maximal amounts for this plan. You can't just make $57,000 and then contribute that into a SEP IRA. You have to make it within those ratios. So remember, it's 25% of your salary is what you're going to base that contribution limit on per year. Now, self-employed individuals calculate the contribution less 1/2 of the self-employment tax. So if you are self-employed and you're not doing this through something like an LLC or a C corp, you do need to keep that in mind. If you're filing as a sole proprietor or a self-employed individual, you have to do that contribution and you have to net out one half of the self-employment tax from that total number before you factor in your contributions. Now, contributions do not have to be made each year, and this is really big, especially for people who might be in things like real estate sales. If you have fluctuations from year to year, let's say you had a knockout year last year, and this year maybe it's a little bit off to a slower start, who knows, vice versa, or whatever the situation may be. SEP IRAs are great, and I'll get into the differentiator between this and simple IRAs in a moment, in that you can change the contribution rate per year with no penalty. So if one year you want to contribute the full 25%, the next year you want to contribute 1 or maybe nothing to that SEP plan, perfectly allowable, offers a great deal of flexibility. Now, the contributions to these plans must be made by the extended filing date if you file for an extension for your business. So if you file as a sole proprietor and you're just going to do all of that on your personal income tax return, then May is going to be your deadline for that this year. Now, if you file an extended corporate deadline, let's say you're filing as an LLC or a C corp, then you have into the end of the year, I believe October 15th presently is still the corporate filing deadline in order to make a previous year contribution. So again, kind of going back into what plan is best, it's going to really depend on what type of business that you're filing as, whether that be a sole proprietor, whether that be an LLC, C corp, and that's going to really determine your strategy for when you are going to make the contribution if you're looking to wait until the last minute. So keep that in mind that if you are self-employed, you want to use a SEP, you can still establish it before the filing deadline in May, but if you're going to file in May, you have to make that contribution for last year. If you want to make your previous year contribution to help offset your tax filing this year, then you're going to have to make that by the filing deadline. And if you file a personal extension, then that would apply as well, only if you are self-employed. Now, keep in mind that these extended deadlines are going to be different than what Corey talked about. Those still need to be made for your traditional and Roths by the applicable personal filing deadline in May. Right. Simple IRAs. So, as I mentioned with the SEP IRA, you can change your contribution rate at any time. There's no issue with that. However, with a simple IRA, not so simple. Unfortunately, these plans, at least just for myself, I find them rather complicated and kind of the opposite of what their name implies in being simple. But it stands for Savings Incentive Match Plan for Employees IRA. So the contribution limits for these plans, you have an elective deferral. Now, I'll say elective deferral a few more times in this presentation. What that means is that you are electing to defer a portion of your pay to the plan, meaning that if your gross pay is, let's say, $5,000 for one paycheck, then you would elect to defer, let's say 3,000 out of that. Then you would take home $2,000 and create a deductible $3,000 contribution into that plan. Now, again, that is going to be specific. If you as the employee, and again, employee can be you as a self-employed individual, you are deferring a portion of your pay electively. It is not a non-elective contribution. Now, the other portion of this, and non-elective means that it is made on behalf of the business for you. And again, I'll show you how this boils down in a moment. So the SEP IRA, 13.5 per person per year can be contributed into the plan, and if you're over 30, you can kick in an additional $3,000, bringing you up to $16,500 per year of what you can take out of what you're being paid. So your take-home W-2 pay, and plug it into the plan per year. Deductible. No such thing as a Roth Simple IRA. Now, the other portion of this plan is made up of non-elective elections made on behalf of the business for establishing this plan. So the company can contribute either 2% of each employee's compensation or 3% matching of each employee's compensation. So you can either say non-elective 2% across the board or 3% matching of whatever they are putting in. So they put in $1,000, then you would put in 30 according to that, or sorry, yeah, you would put in 30 according to that scale, and then that could go up or down. Or you could just say, hey, I'm going to take that and what I'm taking home, multiply it by 0.02, and you get that factor. So again, these are a little bit more complicated, and the bad thing about that is that the corporate side of this, you have to elect to do that for 2 full tax filing years, meaning that if your revenues change from year to year and you say, hey, I'm going to lock in myself to doing this, and let's say you do have employees, you're still on the hook for making those corporate contributions. You can't remove those or change those for 2 years after you establish the plan. So definitely a lot less flexible. Uh, uh, rules for a simple plan. An employee cannot be covered by any other simple plan. So if you have an employee, maybe someone that does some general maintenance on your properties and they're covered by someone else's simple, they can't be covered under yours. You cannot roll out or take funds out of this for the first 2 years that the plan is established. And you have to include all employees that make over $5,000 per year. So there are a lot of regulations that go into this. I really only tell people, if you're self-employed and you come to me and you say you run a kayak rental that has some people that work during the summer and things like that for you, these are the plans for you. If you're self-employed, just you as the sole operator, really probably not the best fit. I'd always tell you to kind of look at the SEP, look at the solo 401k, then look at the simple as a last kind of effort to make sure that you're kind of covering all your bases. But I'm not going to cover too much more into that. We'll kind of go over some advantages right here. So SEP and simple IRAs, typically they are less expensive to administer and relatively simple, depending on which one you go with. Contributions are made to IRAs, so these are types of IRAs, and you maintain no fiduciary liability. Now, what is a fiduciary? If people aren't familiar, is that means you have to act in a manner representing someone that is in their best financial and personal interest. If you don't, then there can be a legal claim made against that person that is acting as a fiduciary. Now, we'll get into that in a moment because 401ks do have a fiduciary component because there is a trustee of those plans. So with that comes liability, maybe needing to carry additional insurances. So that's, again, why SEP and simple IRAs can be really beneficial for you from a liability standpoint. Now, the individuals for these can choose their own IRA custodian. Again, if you're self-employed, that means you're the one making that decision. And they have flexible contribution and distribution features. I don't really necessarily think that is so true, but I like to include that from just a slide perspective. I don't feel that the 401k is inherently that much more complicated, but some people might. And then employee contributions are only those to 2 years of service for a simple IRA and people with 3 years of service with a SEP IRA. They definitely get a lot more finite when we get into the solo 401k. So before we get too far deep into that, just double check into questions. I don't think we really have anything
Nothing really
else.
new since Sarah's last question, Alex. Everyone, if you do have questions, feel free to throw them in the chat box, in the question box, and I will convey them over to Alex accordingly. Thank you.
Oh, so we got about 15 minutes left. We're doing really good on time right now. So solo 401ks. These are the plans that I really like. They are very powerful in the fact that they don't require you to make a ton of money in order to be able to make maximal contributions like a SEP. They don't have as many of the kind of arduous contribution regulations as a simple, and they offer you the ability to also have a Roth employer plan. So that's really cool aspects. You can kind of mix and match these as a, kind of think about yourself going down the line at a cafeteria. You can get a little bit of this, a little bit of that, and kind of make your plan what you want to. You're not kind of restricted by as many defined boundaries as you are with SEP simples, Roth and traditional IRAs. So the contribution limits, and you're really going to kind of have to shift gears here, are very unique to the 401k. You have $19,500 that you can electively defer out of what you're taking home as earned income per year. If you're over the age of 50 and a half, you get an additional $6,000 that you can tack onto that. So if you had take home pay, let's say, and again, this depends on how you structure your business, depends on how you're showing your revenue. You can contribute up to 19,000 or 25,500 depending on your age. So if you made $23,000 one year, which you're showing as your take-home compensation, you can contribute 19,500 to that, or potentially all of it. But you have to factor in your less self-employment tax, so you can almost make 100% compensation contributions to these plans, where with the other ones, SEP and Simples, it's a ratio. So that's a really powerful tool with that, is that if you want to try to reduce all of your earned income for a year of what you're showing from a business, you might be able to do that with this. And then you also have a profit sharing match, which can be 20% of the net operating income of the business not to exceed $37,000. So when you mash these together, you can really kind of see how large the contributions can be, but also you can adjust that ratio. Maybe you only want to contribute $1,000 of your compensation and you want to do all profit sharing, so that you can do that. And again, that's really going to determine how your tax structure is with your business. Let's say you're passing everything onto yourself as a subchapter S and you're going to be receiving the benefit of all the contribution deductions. Well, then maybe you want to do an equal part in each and help to, give yourself good deductions there too. Now, keep in mind, I said you can have Roth. So you can defer your compensation. So that first part, the 19.5 or the 25.5 coming out of your compensation, can be made either deductible or non-deductible, meaning you can have traditional or Roth funds within that plan, and you don't have to do it all the same. You can have traditional funds mixed in with Roth funds. Now, if you do commingle, you need to make sure that one, you're employing a bookkeeper to track your net earnings attributable to the Roth and the traditional basis of that. So you can add some complexity in there if you're mixing Roth and traditional 401k funds. So just keep that in mind. And then all of the profit sharing matches are always going to be made before tax. But the other benefit of this is that you can make in-plan Roth conversions. So if you want to, create a deduction one year, maybe you have some carry forward losses the next year, you can convert in plan and try to get everything into a Roth if you want to. Or if you're just someone that wants to go straight line, get as many deductions as I can, you can make it all traditional or anywhere in between. So again, this is one of the really cool things that I like about these plans. Some rules: solo 401k cannot cover businesses with rank and file employees. So remember, if someone's worked 500 or more hours for 3 out of the past 5 years, or anyone that has worked over 1,000 hours per year for you, anyone that is over the age of 21, and is not covered by a collective bargaining agreement, all those kind of people. So, the majority of the people that would work for a business, if they are there, you can't use the solo 401k. You can still use a 401k, just has to be a little bit more compliant. It's what's called safe harbor plan. So you'd need to get with someone that specializes in that and can do the auditing and the special testing regarding that. And again, you can change the contribution limits from year to year. Another really great aspect of those plans.
Alex, we do have 2 new questions before we jump into the next slide if you want.
Sure.
Okay, the first one comes from Kevin Smith. Can you contribute to both a SEP IRA and a Roth?
Yeah, absolutely. So you can make so let me kind of explain something interesting. So a SEP IRA is kind of like the wrapping on a traditional IRA. So think about the traditional IRA as the small thing in the large Christmas package, and then the SEP IRA encompasses it. So you have the traditional IRA component of that, and then you also have your SEP component. So if you only make your SEP deferral and don't make any of that traditional IRA contribution, you can make a full Roth contribution. But if any part of that package is traditional IRA contribution, so part of your $6,000 or $7,000 per year, you can only do the net difference to a Roth IRA annually for that contribution. But also keep in mind, if you want to do something where you're making SEP contributions, so you're cranking up and you're getting that 75 grand in there, the 25% of your compensation into that plan, and you want to do a Roth conversion, you can immediately convert that as well. So depending on what your strategy is there's a lot of ways to get SEP money into Roths. You can also contribute to a Roth additionally, but you just got to keep in mind if you also have contributed to a traditional underneath that SEP plan, then it's going to be the difference of your contribution limit for that.
Thank you, Alex. And the second question actually from D Mayo, can a simple IRA be converted to a SEP or a solo K? If so, what are the rules?
Sure. So good question. And it actually does, it's not just as simple a yes or no answer. So if you contribute to a SEP IRA, and then let's say you decided to change your strategies and open up a solo 401k, absolutely. You can roll those funds directly into the 401k, not a problem. However, with the simple IRA, and again, going back to the fact that I wholly disagree with the fact that they name these things simple IRAs. If you establish that plan and you've contributed to it, you have to wait 2 full years before you can roll funds out or make any applicable plan changes to that simple IRA. So although the answer is, in a sense, yes, for can you roll out funds or move from a simple to a solo 401k, it's going to depend on how long you've had that plan open. If you establish a simple and you put a single dime into it, that dime is going to be locked up for 2 years. So if you make a full contribution one year and let's say something changes, remember you have those non-changeable, either non-elective contribution of compensation or the matching contribution that have to be maintained for 2 years in that simple IRA. And also you can't change or roll out during that time period as well. So again, yes, with an asterisk for simple, with a SEP, absolutely you change it, kick it right out into a solo 401k, not a problem. But if you're talking about maintaining both of those plans at the same time, that's when you're going to run into a lot of different issues. You can be covered under multiple retirement plans, but it is going to directly impact your ability to make contributions to those plans and at what rates. So again, there's a little bit more context to that, but in generalities, yes, you can move those funds between each other.
Thanks, Alex. And one other thing that was added to the question block, it doesn't look like a specific question, but this is coming from Sarah Jones again, and I think it ties into the next slide you're about to present. Her statement is just, some solo K plans also allow after-tax contributions besides profit share and elective deferrals. So seeing that you're about to jump into solo K advantages, feel free to jump back in.
Okay, great. So Sarah, thanks for the question. Now, without kind of getting too far into some really technical stuff, which I would be more than happy to kind of dig into this with you. If you want to give me a call, maybe later, shoot me an email, we can schedule a consultation. But what essentially she's asking is that some plans allow, and we do offer our solo 401k for this, is that if you have made your you have maximized your corporate contribution to a solo 401k plan. So the 20% of the net operating income, let's say it came to $20,000 that year. Well, if you want to, what you can do is you can make an after-tax contribution. So money you've already paid tax on, you can make up the difference between the corporate profit sharing plan contribution amount and the limit and any ratio that you'd like to with after-tax money. So creating what people like to call the mega Roth 401k. That's essentially what that question was regarding. Yes, those plans can allow for it, but you have to be careful because not all plans do. The interesting thing about 401ks is that the plan administrator and document provider can write in these features or not. So a solo 401k from us is a high degree of probability going to be very different from a solo 401k if you got it from someone like Fidelity. It may not allow for you to take loans out of the plan. It may not allow for after-tax contributions. It may not allow for Roth components either. So just keep that in mind that you need to kind of check and see what the plan that you're getting is offering. Our plan absolutely allows for all of those options. So the advantages of a solo 401k, and I know I kind of pontificate how much I like these. I hope it kind of comes across, but the solo 401k has a lot of really good benefits to it. You have higher funding limits. You have defer a larger portion of your earned income, and you have that flexibility to do your pre and post tax and also the profit sharing for that. You have different rollover opportunities. One thing that I would kind of put a pin in for that though is that one of the weird kind of rules that the IRS has is that although you can have a Roth 401k and you can roll funds directly from that Roth 401k to a Roth IRA, you can't fund a Roth 401k with a Roth IRA. It is a very strange rule. I don't understand why they did it, but they did, and it's there. So keep that in mind. If you want to start a solo 401k, and let's say all of your money is in Roth accounts, and you wanted to kind of use that as the seed to get that plan up and running, unfortunately, you cannot do that. Now, you also have access to tax-free loans, meaning that you can take up to, well, it's gone down. It used to be $100,000 last year, but now it's $50,000 or half of your vested plan balance as a personal loan. So it's not taxable. You pay that back to the 401k. You have flexible distribution options, really cost-effective administration as well, because you can either do things a multitude of different ways with doing your own record keeping and bookkeeping or anything in between. So just keep in mind, solo 401k is really great, but again, it's not for everyone. If you're a self-employed individual, there's definitely some things to consider. A few tax updates that have kind of come out with regards to these plans. It used to be, prior to this year, that you had to establish a 401k plan by December 31st of the year in which you wanted to make the contributions. One of the really good benefits to the previous administration's Tax Reform Act, the Secure Act, was the abolition of that restriction, meaning that now if you want to utilize a solo 401k but you didn't have one established by year end of last year, you can establish one prior to your tax filing deadline plus extensions for that business. Keep in mind the rules that I mentioned on that, and you can make the profit sharing match. You may not be able to necessarily make the deferral of compensation because that's already paid out and that needs to be contributed at the time of payment, but you can still make the profit sharing match so that 20% of the NOI up to um, $37,000 can still be made up into the tax filing deadline. So again, a lot of really great stuff. We'll kind of kick it in. Now it's time for questions and answers. I'll put up Corey and I's contact information. So we have about 5. We'll stick on, as long as there's some people here asking questions, but that's pretty much the end of the content for the slides. Again, thank you all very much for coming. We do apologize for the technical difficulties at the beginning. If you have any questions, now's the time to answer them. Now's the time to ask them and we will answer them.
Yeah, Alex, I have a question on the chat block from Martin. Can you set up plans over several different entities? And if so, are there maximum contributions? I believe, Martin, the answer ties into what specific types of plans you're referring to. As far as traditional and Roth, as I mentioned earlier in the presentation, there is a cumulative contribution limit. Alex went over the contribution limits for the other types of plans as well. So I think the answer to that specifically must be delineated in what type of plans you're discussing. And then, yes, you could set up different plans at different entities as long as the applicable contribution limits are mandated and applied to.
Yeah, and again, to piggyback on that, it's really going to depend on the type of plan you're talking about. So Roth IRAs, obviously those are individual, but if you're talking about business plans, so let's use a 401k for example. You have that 19.5 of what you're deferring out of your personal pay, and then you have that other profit sharing match, the 20% of the NOI up to $37,000. Well, let's say you have multiple 401ks covering you. You can only make up to the total 19.5 or the additional 6 of your deferral from your compensation across all plans. So that's a total. You cannot have more than that just across any of them. So you might be able to max out one, but you can still participate in profit sharing of multiple plans. Excuse me. So depending on what your business model looks like, especially if you're self-employed, maybe you have holding companies and other things, there's a lot of opportunity to maybe be covered by multiple plans to help increase your contribution limits. But there's also a lot of other rules you get into with that. So if you want to kind of break that down, give me a call, shoot me an email. We can kind of go through that.
And Alex, next after Martin, we've got Gary Hayes. I'm a realtor and also have rental properties. I'm 77 years old. I'm confused about what options I have to shelter these two incomes, that being rental and real estate sales.
Fantastic question, Gary. Happy to get into that. So, with your current age, you're over the age of being able to directly contribute to a traditional IRA. However, that has nothing to do with the fact that you can still participate in things like 401k plans, SEP IRAs, simple IRAs. You're never going to be precluded from contributing if you're still, long as you're still, quote, working. So as a realtor and you have rental properties, again, that's going to be kind of depending on how you're showing your revenue. Without knowing, your personal taxable situation, just kind of an example. If you're generating revenue, and let's say you're filtering that through an LLC, and you're showing all that as earned income, like W-2 income, well then having a SEP IRA might be really great for you if you're trying to defer the taxes that you're paying. Keep in mind that that is going to be tax deferred, so you're getting a deduction. Uh, contrarily, let's say you wanted to use a solo 401k and just get that money into tax sheltered things, not necessarily creating deductions. You could make after tax contributions to that solo 401k attached to yourself and help to, put things into tax, into Roth or traditional. So it really kind of depends on what your taxable situation is, what your ultimate goal is, but you're never kind of out of the fight with that. Just so long as you're still earning money and it's not just from Social Security, there's always going to be options for you.
Thanks, Alex. Next question, it looks like comes from Sarah Jones again. For your solo 401k, do you need to do a profit share, or could you just max it out with elective deferral and after-tax contribution?
Well, it's going to really kind of depend. So the after-tax contribution is going to have to be from revenues generated by that business. So you're going to have to say, okay, let's say you don't make the profit sharing contribution, but you only paid yourself $20,000 out of that business per year. Well, you make your 19.5 elective deferral contribution, and let's say you earned a bunch of money from, let's say you owned a Starbucks or something, or let's you make a bunch of money from some other business. Well, at that point, you can't take after-tax funds that are attributable to another activity that you have and and contribute those after-tax to that plan. But if you want to pay yourself out from that plan and then use those funds to contribute after-tax to that 401k, that would be allowable. So again, there's a lot of context to a lot of this stuff. So the answer can be yes, but it depends.
And it looks like we have one question. Given that it's now 1 o'clock, if there's no other questions that come in, we'll consider this the last question. Comes from Kevin Smith. Which plan would be best to flip houses and avoid UBIT? Alex, I'll let you take that, but if I'm not mistaken, that's going to be the solo K plan, and I'll let you elaborate.
Yeah, so there's definitely a little bit of context that's needed with that one as well. So for those of you that are not familiar, UBIT stands for Unrelated Business Income Tax. And specifically, what it means is that if you are operating something outside the scope of the tax sheltered nature of the entity in which you're doing business, then you might have to pay some taxes. Now, UBIT has a subset to it called Unrelated Debt Finance Income Tax, which is uh, more specific to what IRAs typically do. What that means is that if you finance a property in an IRA or any other type of retirement plan besides a solo 401k, you're going to have to pay taxes on the portion of the revenues generated by the leveraged part of the property. Here's some easy math because that's kind of a mouthful. If you buy a $200,000 property and you finance $100,000 of it, then if it's generating $2,000 a month in rent, then $1,000 of that is subject to debt finance income tax underneath of UBIT. When you sell the property, you get whatever is the other half. You divide by two. The other half of what you make is subject to debt finance income tax. Now, that can be kind of a big pain for IRA investors, but 401ks are exempted from paying any type of UBIT tax the on using acquisition debt, meaning that if you finance the purchase of a new piece of real estate, that is completely exempt for it. So if you want to flip houses using debt, then the 401k is not only the best option, it's your only option. However, like with everything, context is the key is in, between the lines of this, is that 401ks can still be exposed to UBIT. If you are deemed to be operating a trade or business from a tax sheltered plan like a 401k, you can still get hit with UBIT. So for flipping houses, if you're using debt to acquire the properties and flip them, that won't generate a UBIT liability. But let's say the IRS were to audit you and say, hey, you're operating a business trade out of this tax shelter, then they could hit you with UBIT. So again, it really kind of depends on the context of where you think that liability is going to come from. But for acquisition debt for new real estate, 401k, hands down, the only option will be fully exempt from that tax.
All right, thank you, Alex. And seeing no further questions, I know Alex already mentioned it, but thank you again for everyone for participating, having patience with us getting started today. I know my dog was barking early on in the background as well. So thank you all for participating and throwing your questions in the chat block. This session will be recorded, and we will be sending out the recorded session usually within a day or two, to all participants in case you wanted to look back or recall any of the specific details conveyed. And furthermore, if you have any specific questions, please feel free to reach out to Alex or I via phone or email, and we will be very happy to assist you and talk over your strategies with any self-direction investments you may look to make. Alex, any final words?
That's it, Corey. Thanks for jumping on this and doing this with me today. It was great to have you on, and I always really enjoy doing these things. Again, if there's any questions, we are always happy to help. Thank you. Hope everyone has a wonderful rest of the day. Be well, and we will see you on the next presentation.